Welcome back, everyone. My name is Doug Burson, CPA. For those of you who haven't been here yet, I'm glad you're joining us. Today I want to talk about tax tips. 2020, it's almost over. It seems like it's been an eternity in so many ways, but yet it has flown by, and the world is definitely different. But what hasn't changed, at least I think it hasn't, is your desire to lower your tax bill. And if that's not you, then this video probably is not for you. But for those of you who do want to lower your taxes, there is still time to make some moves that could lower your taxes for 2020. So let's get started. Number one, sell assets with long-term capital gains this year. We currently still have a 0% tax rate. And what that means is you don't pay any taxes on them. So we have a 0% tax rate on the gain if your income, if you're married filing joint, is not over $80,000. And we don't know what the next couple of years are going to be like. That very well could go away. So how does that work? What are you talking about here, Doug? You're asking? Well, here's how it works. Let's say you're married filing joint, and between the two of you, you made $90,000 this year. And to keep it simple, your standard deduction is $24,000. We know they raised that way up a couple of years ago. So you take 90 and subtract 24, your taxable income is $66,000. So what that means is you could sell $14,000 worth of taxable gain and pay zero tax. That's a big deal. Maybe you've got a stock out there that's gained quite a bit of ground and you think maybe it's at the ceiling. You could sell it right now and not pay any tax on up to $14,000 of gain. That is a big deal. So if you're finding this information useful, please hit the subscribe button down below. It helps me know the videos that are useful to you, and it will also help you keep informed of tax topics as they come up. We're working hard here to make sure that our clients are the most informed clients in the market. And if you're not one of our clients, well, then this one's free, and I'm glad we could help you too. So number 2 on the list I had today is charitable contributions. Under the new related bills, you can deduct, the COVID bills that is, you can deduct $300 charity above the line. We've never had that before. So you can actually give $300 to Salvation Army, Goodwill, whatever, in cash, and get to deduct it right on the front page. Not a big deal, but every little bit helps, right? If you're in a 30% tax bracket, you just put $100 back in your pocket, and this video was free. It was free anyway. But you see what I'm saying? So this is a nice little thing for a lot of us who we just can't itemize anymore because of the 24,000 I already talked about. This lets you do that. And the idea was during COVID just to try to encourage people to help places. So let's make sure we don't miss that. And if you did do some charities, let me know. Or let your preparer know, and make sure you don't miss this one. So number 3 on the list is bunching expenses. And this is something we've always been able to do. But what do I mean by bunching expenses? Well, the standard deduction is now over $24,000. And this makes it hard for most of us to have enough to itemize. So what do? Well, we double up expenses. And this works mostly with medical expenses or charitable contributions. And by medical, I mean you've just opted that you want to do something. Maybe it's get your teeth improved. Maybe it's get eye surgery, things that we have control over. You could choose to do that all in one year, as well as your charitable contributions. Instead of waiting till January to make the donation, let's go ahead and pay a couple months early, get it into this year, and that will give us enough to go ahead and itemize. And the way you do that is you bunch them up. So maybe we're going to push them all into 2020, and then in 2021 we will wait a little bit, do the standard deduction in 2021, and then bunch our expenses back together in 2022, so that every other year we itemize and we get the tax advantages of it, and every other year we take standard deduction. This can be very helpful if we time it out right, and it takes a little bit of planning, and we got to think about our charities. Maybe we can put a little bit up front and then dole it out how we like. but this can be a way for you to get back to itemizing when right now you currently can't. And on that same concept, under the new COVID bill that happened this year, it went from 60% of income to 100% of income. I know for most of us that isn't an issue, but I have had clients that have basically given their entire income that year to charity because maybe they didn't need it, they had a windfall, a lot of different things could happen. But you can give up to 100% of your income to charity and deduct if it's above the standard deduction. Let's not get confused on that portion. And you can also do this with your estimated tax payments. So remember, there's the $10,000 threshold, the max we can do in state and local taxes right now. But if you're below that and you make estimated state payments, make the January payment in December. Make it a little early, and we can get more of those deductions in this year. Okay, guys, stay with me. I know this isn't the most exciting stuff, but one of these ideas may be good for you. So don't stop. Keep in it with me, and we'll be through this as quick as I can. But number 4 is donor advised funds. And this one's pretty cool if you have disposable cash. So, and we'll probably cover this more in another video because it's a more advanced way of going about doing things, but I want you to be aware of it. And the short story is you can put money into a fund, a charitable fund, and deduct it all this year, and then over the next however many years you want to, you can advise the fund to make contributions on your behalf. And what that allows us to do is essentially bunch up our contributions. So maybe I'm going to put 20,000 into this fund. I like to give 10,000 every year to my church. So I'm going to put 20,000 in right now, and then over the next 2 years, I can dole money out of that fund to that charity so their income stream stays the same, but I got to deduct it this year. And they work really well because the fund knows that if they don't put it where you want them to, you will not invest more money with that fund. And that's all I want to say about that, but it's a very cool idea, especially if you have larger sums of money that you would like to donate and then spread out over a couple of years and not get stuck with the $24,000 limit every year. Maybe we do this every so many years and get that tax deduction right there, and that could be a really, really big deal. All right, so let's talk a little bit about required minimum distributions. If you're over 70 and a half and you have an IRA, you know about these, or you better know about these. And if you don't, make sure you talk to your investment guy or your tax person, because you don't want to miss this. It's very, very painful on your taxes if you forget to do your RMDs. So make sure you don't miss that. But this year is different. Because of the COVID rules that they passed this year, you are not required to take an RMD this year. And so if you haven't done it yet, you don't have to. And that can be a big deal because I know a lot of people right at the end of the year, they rush to get these done, and you don't have to, because when you do one, what happens? Well, you just took money out of the IRA that you didn't really want, and now I got to pay taxes on it because it's taxable income. So if you don't need it this year, you don't have to do it. And if you did do it and it's been within the last 60 days, check with your advisor. Within 60 days, you may be allowed to put it back in to that IRA and therefore consider it essentially a rollover, non-taxable rollover, and you would not have to pay taxes on it this year. So that's a big deal this year. You don't have to take your RMD in 2020. If you did, and it's within the last 60 days, it may still be fixable. Now, on the same concept of RMDs is something called a QCD, and I love these things. QCDs are great. So what that is a qualified charitable distribution. And so let's say you're somebody who just doesn't have enough contributions for bunching to make sense, or you just don't want the headache. It's just more planning than you want to deal with, and that's not your kind of thing. Well, the QCD may be the solution for you. So what the IRS has said is if you have a required minimum distribution, what you can do is instead of taking that money out yourself, you can get with your IRA provider and then have them pay that money directly to the charity of your choice. So maybe it's your church or whatever organization is that you're wanting to support, as long as it's a charity. You can have that RMD paid directly to them. Why does that matter? Well, because what happens when you take an RMD out is you get taxable income. And then you make a charitable contribution, but you don't have enough to itemize. So you just took money out, paid taxes on it, and then gave money to a charity and didn't get a deduction. With the QCD, we can avoid all that, and you can take that money straight from the IRA, give it straight to the charity. You've now supported the charity that you wanted to, without causing yourself to have to pay taxes on the RMD. And this is a fantastic tool for people who don't want to mess around with bunching and just want to keep their life simple. And I've got a lot of clients that are doing these. They work great, and it's a really nice thing to do at the same time as you're saving taxes. All right, number 7, we're moving along here now. Retirement plan distributions. If you have a retirement plan and you wanted to take money out in 2020, a lot of you have heard, and it is correct, that you can take that money out without paying the 10% penalty. And not only that, but you can spread the taxes out over 3 years. And not only that, you can put the money back and not have to pay the taxes. I don't know how many of you are really going to do that, but it is possible. It's a crazy, crazy law. But what does it mean? Well, what this really means is you can pull up to $100,000, I believe, out of your retirement account, and you can use it for anything you want and spread the taxes out over the next 3 years. But there are some catches. One, you have to have been negatively impacted by COVID. I think most people probably have, but you need to know that there are some rules here. And if you're thinking about this, go to the IRS's website, you can see some stuff on there. But you had to have experienced what they say adverse financial consequences. That could be from things like quarantine, from being laid off, from reduced hours at work, from not being able to go to work because you had to do childcare. A whole list of things that are there. But essentially, you had to have had a negative impact from COVID. They didn't say 5%, 10%, 20% negative impact. That's not there. So just be careful, but know that if you've been negatively impacted, this could work for you. Do I recommend it? To be honest, for most people, no. I know how we are, and looking in the mirror, actually I'm looking at a camera, once the money's in your hand, we seem to find something to spend it on, and once we spend it, it's gone. And so now over the next 3 years, I'm going to have to pay taxes on this money that essentially I probably wasted. And on top of that, that money is no longer in my account growing. And so that's something I want us to be thinking about. It's something I don't want us to take lightly. It's not free money. You are still going to have to pay taxes on it. We're just avoiding the 10% penalty, and we're spreading it over 3 years. What's going to happen in 2021 and 2022 when you have to pay the taxes on this, and the money's been spent on a new car 2 years ago because you went and did something silly, and we still got to pay taxes on it? So don't do this just to do it. But if you're in a situation where you need to, it is true and it does work, but let's not be doing things just because they said we can and then cry for the next 2 years because we owe the taxes. Okay, number 8, we're getting close, only a couple more for this video. HSAs. I love HSAs. I think they're great. You get to take a deduction for a medical expense that hasn't happened yet, and if you don't need it, you can use the money in future years. And what's even better is it's not like an FSA. It's not a use it or lose it. You remember the FSA, you told your employer, I want to put in $4,000 or whatever the number was. I don't remember now. You put in the number, and then you didn't use it. Well, guess what? It's gone. With an HSA, that's not the case. You put the money in, you get the deduction right on the front page. It doesn't go on the Schedule A where we're probably not going to have enough to itemize anyway. We get to use it for medical expenses. When we use it for medical expenses, it's not income, so it gets to grow inside of this fund. We get to use it for medical. We get a deduction. We can take it out tax-free. I mean, this thing is a win-win. But there are a couple catches. One, you have to have a high deductible health plan. That's what you got to do. If you don't have a high deductible health plan, this doesn't work. Right now, I'm on a health share ministry. I can't use it anymore, but I love my HSA when I had one. They're fantastic. And one of the great things is you can even contribute after the end of the year. So let's say it's February, we're working on your tax return, and you're going to owe taxes, and if we can get your income down, it's going to really save you a lot. You can go up to UMB or whoever's handling your HSA, make a contribution, and reduce last year's taxes. I mean, this thing is wonderful. So we'll probably talk about these more later. But if you have an HSA or you don't, and you have a high deductible health plan, I highly, highly, highly recommend setting one of these up. Make all your medical expenses deductible. You need to go get a pair of glasses, take money out of your HSA. By putting money into the HSA, you just made your glasses deductible. It's wonderful. Okay, enough about that. I think you get it. HSAs are great. Number 9, cafeteria plans. This is more of a tip for next year, but unfortunately by the time I see a lot of you in tax season, it's already too late. So I want to cover this now. Don't miss the opportunity at work this year to get your cafeteria plan set up. It's probably, for a lot of you, the simplest and best way to do tax planning is with this cafeteria plan, because you can contribute to your, maybe you have daycare, and you can do a daycare expense through there and make it pre-tax. Fantastic. Maybe you have an FSA. We just talked about those, or maybe you have an HSA. I'm not sure what your plan has, but you can contribute to those and get a tax deduction right off the top, but you have to decide now. It's not something that in March you can go to your employer usually and say, hey, I was talking to my tax guy and he said I should be using this for child care. They're going to say, we're sorry, you missed the enrollment period. So if your HR department is talking about the enrollment period for all these things, don't ignore it. This is huge, and probably one of the best tax things you can do for a lot of you is get in there. And what about the 401k plan? If you have an employer who's doing a match and you're not doing a contribution, come on, take advantage. Make sure you contribute enough to at least get the match. That's like throwing away free money. And we get a tax deduction for accepting free money from our employer. Got to do this. This just makes so much sense. And so often people come in, we do their taxes, and they didn't do it. So don't let that be you. Take advantage of your cafeteria plan this year. Number 10, postpone or manipulate income. You can say the same with expenses. It's important to know where you stand. You need to know where you are, especially when it comes to things like Obamacare, deductible IRA limits, education credit phase out, student loan interest, and 0% capital gains rates. And we'll help you a lot of that during tax season. But it's important that you try to understand some of this. And if you know you are close on some of these thresholds, you could ask to maybe, if your boss will let you, get your bonus in January instead of this year, because it's going to make a major difference on your tax return. He's probably going to tell you no because he wants a deduction this year, but maybe. Or maybe based on how you're doing your billing, if you're self-employed, you can manipulate your income that way. Or you could buy a new piece of equipment and lower your income if it makes sense for you. But the important part is, if you make a contribution to a traditional IRA or an HSA, or sell an asset that's been a loser, take advantage of the tips we've just been going through, it can sometimes have an incredible impact on your return. I have seen literally a few $100s make nearly a $20,000 difference on a client's tax return related to Obamacare and keeping his income below 399% of the poverty level. That is a massive one. If you're at 399, you only pay 2,500 back. If you're at 400, you pay it all back. So if you had $20,000 of Obamacare and your income is at 401%, we need to do something to get your income down, right? And it can make a massive, massive, massive difference. So that's my big one. Know where you are on your tax return, and it can save you a lot of money in a lot of cases. So that's it for today. We'll do more. There'll be more coming out. I have a feeling a lot of things are about to change in the next few weeks. At least I hope so. And as they do, I'll bring you more. And we'll also continue to try to educate you the best that we can. So let's have a wonderful, wonderful tax season, and let's all try to stay safe.